All right, today we are jumping into one of the most explosive and honestly most misunderstood forces in the modern market, the gamma squeeze. You've probably heard the term thrown around, especially with all the meme stock craziness. But what does it actually mean? Well, that's what we're here to do. We're going to break it all down piece by piece. Let's get into it. So it really all comes down to this one pretty wild question. How can a whole flood of relatively small bets from tons of different people create a feedback loop so powerful that it literally forces Wall Street's hand and creates a buying frenzy that sends a stock's price completely parabolic? It sounds like it shouldn't be possible, but as you're about to see, the plumbing of the market makes it happen. Okay, so to really get this, we've got to meet the two main characters in this whole drama. Their goals are completely opposite, and it's that clash that sets the whole stage for the fireworks. So on one side of the ring, you've got the speculator. This could be anyone, maybe a retail trader, right? They're making a big leveraged bet that a stock is about to go to the moon. And in the other corner, you have the market maker. Just think of them as the house, like a casino. They don't want to bet on the stock's direction at all. Their entire job is to just provide liquidity and make a tiny little profit on the transaction, the bid-ask spread. Their number one goal is to stay neutral. So here's how the bet gets placed. Our speculator, they go and buy a call option from the market maker. For just a little bit of money up front, that's the premium, they get the right, but not the obligation, to buy 100 shares of a stock at a fixed price. Now, if the stock rockets past that price, they can make a fortune. If it doesn't, well, they only lose that small premium they paid. It's a classic low-risk, high-reward bet. But for the market maker on the other side of that trade, they just took on a whole lot of risk they need to get rid of fast. Right, so what does the market maker do about all this new risk? Well, their solution. That's the absolute key to understanding this entire gamma squeeze phenomenon. See, the market maker is now short a call. In plain English, that means if the stock price goes up, they start losing money, a lot of money. But remember their goal. They're the casino. They don't want to bet on red or black. They want to be delta neutral, basically perfectly balanced so they're not exposed to the stock's moves. And the only way they can do that is to hedge. So how do they do it? How do they hedge? Their go-to tool is something called delta. Think of delta as just a simple number, a ratio, that tells the market maker exactly how many shares of the actual stock they need to buy to perfectly cancel out the risk from that option they just sold. It's their first line of defense. Okay, let's make this super concrete. Let's say our speculator buys a call option, and that option has a delta of 0.28. To hedge that, the market maker immediately goes out and buys exactly 28 shares of the stock. And for a split second, boom, they're balanced. They're neutral again. But, and this is a huge but, that neutrality is super, super fragile. And that fragility, well, that brings us to the real star of the show, gamma. This analogy is perfect. If delta is your speed, gamma is the accelerator pedal. It's what measures how fast delta itself is changing as the stock moves. And the most important part? Gamma is at its absolute highest when a stock's price is getting close to the option's strike price, which makes the whole situation incredibly explosive. Okay, now watch this. Let's see how this actually works in practice. Let's say the stock ticks up by just one single dollar. Because of gamma, that old delta of 0.28, it's gone. It's now, say, 0.31. Uh-oh. Suddenly, their hedge of 28 shares isn't enough to keep them neutral anymore. To get back in balance, they have to own 31 shares. So what do? They're forced to go out and buy 3 more shares. They have literally no choice in the matter. They're forced buyers buying into a rising price just to stay safe. And that right there, that forced buying, that is the absolute heart of this whole thing. We've seen all the pieces, so now let's put them together and watch the fireworks. Okay, now just stop and think about this for a second. Everything we just walked through, that whole process, that was for one single options contract. So what happens when it's not one person, but thousands, tens of thousands of people, all buying the same call options on the same stock all at once? Well, that's when you ignite the gamma squeeze engine. It works like this. All that call buying gives the stock an initial push up. That price rise, because of gamma, makes the delta on all those options shoot up. This forces the market makers to buy more and more shares to stay hedged. But all that buying, that's a huge wave of demand. It pushes the stock price even higher. And guess what? The whole cycle starts over again, but faster and more violently each time. It's an insane feedback loop. And look, this is not some abstract financial theory. We have all seen this play out in the real world in the most spectacular way possible. I'm talking, of course, about GameStop. Yeah, the whole GameStop saga back in 2021, it was the definition of a perfect storm. Because it wasn't just a gamma squeeze going on. At the exact same time, you had a classic short squeeze happening. That's when people betting against the stock are forced to buy it back to stop their losses from spiraling out of control. When you put those two together, you get a double squeeze.
So picture this. You have two completely different groups of people, both massive, both desperate, and both forced to buy the same stock at the same time. You've got the market makers, who are mechanically forced to buy shares to hedge that tsunami of call options from retail. And then you have the hedge funds, who are frantically buying shares to close out their short bets before they go bankrupt. Two different reasons, one overwhelming result, a tidal wave of buying pressure. And the result? Well, the result was this, an absolutely vertical price chart. A stock that was trading at, under $20 at the start of the month, hits an intraday high of over $480. This chart just perfectly shows the sheer explosive power we're talking about.
But here's the thing. This wasn't just some crazy one-time fluke. The GameStop event really pulled back the curtain on a fundamental rewiring of how our markets can operate, and we are still dealing with the consequences today.
There's this saying that perfectly captures it. The tail wags the dog. The tail, the options market, is now whipping around and driving the price of the dog, the actual stock market. It's a total flip. Price discovery isn't just about company fundamentals anymore. It's being driven by these huge, mechanical, almost robotic hedging flows. And if that wasn't crazy enough, this whole effect is now on steroids, thanks to the explosion of zero-day to expiry options, or zero DTEs. With these options, the gamma is just off the charts. It means you can compress what used to be a weeks-long gamma squeeze into a few hours, or sometimes just a few minutes.
And all of this leaves us with a really big, kind of scary question. When a stock's price can go parabolic, not because the company did something amazing, but because of the mechanical hedging rules of options dealers, what does fundamental value even mean anymore? It's a question that really challenges the way we think about how markets are supposed to work.